Welcome to our comprehensive guide on financial analysis. In this video, we will explore the essential concepts, methods, and tools that are fundamental to understanding and evaluating financial performance. Whether you are a student, a business professional, or simply interested in finance, this series will provide you with a structured overview. We'll start by defining what financial analysis is and why it matters in both business and personal decision-making. As we move forward, you'll see how these concepts connect and build upon each other, forming a solid foundation for deeper financial understanding. Financial analysis serves several important purposes. It helps organizations and individuals assess their financial health, make informed investment decisions, and plan for the future. By examining financial statements and key metrics, analysts can identify trends, strengths, and weaknesses. This process is crucial for risk management, strategic planning, and ensuring long-term sustainability. As we continue, we'll see how financial analysis is applied in real-world scenarios, providing valuable insights for both companies and investors. There are several types of financial analysis, each with its own focus and methodology. The most common are horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis compares financial data over multiple periods, highlighting trends and growth patterns. Vertical analysis examines each item in a financial statement as a percentage of a base figure, making it easier to compare companies of different sizes. Ratio analysis uses key financial ratios to evaluate performance, liquidity, profitability, and solvency. Understanding these types will help you choose the right approach for any financial question. Perform financial analysis. It's essential to understand the three main financial statements: the balance sheet, the income statement, and the cash flow statement. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. The income statement shows revenues, expenses, and profits over a period, while the cash flow statement tracks the movement of cash in and out of the business. Together, these documents offer a complete picture of financial health and performance. Balance sheet is a foundational document in financial analysis. It lists a company's assets such as cash, inventory, and property alongside its liabilities like loans and accounts payable. The difference between assets and liabilities is the company's equity, representing the owner's stake in the business. By analyzing the balance sheet, you can assess liquidity, solvency, and overall financial stability. This understanding is crucial for evaluating a company's ability to meet its obligations and invest in growth. Income statement, also known as the profit and loss statement, details a company's revenues, expenses, and profits over a specific period. It starts with total sales, subtracts the cost of goods sold to find gross profit, and then deducts operating expenses to arrive at operating income. After accounting for taxes and interest, the bottom line is net income. Analyzing the income statement helps you understand profitability, cost control, and operational efficiency. Cash flow statement tracks the movement of cash in and out of a business. It is divided into three sections: operating activities, investing activities, and financing activities. Operating activities include cash generated from core business operations. Investing activities cover cash spent on or received from investments, like equipment or securities. Financing activities reflect cash flows from borrowing, repaying debt, or issuing shares. This statement is vital for assessing a company's liquidity and ability to fund operations. Horizontal analysis involves comparing financial data across multiple periods. By examining changes in revenues, expenses, and profits over time, analysts can identify trends and growth patterns. This method is especially useful for spotting consistent improvements or emerging problems. For example, a steady increase in sales may indicate successful marketing, while rising costs could signal inefficiency. Horizontal analysis provides context for understanding a company's financial journey. Vertical analysis expresses each item in a financial statement as a percentage of a base figure. For example, on the income statement, each expense might be shown as a percentage of total sales. This approach makes it easier to compare companies of different sizes or to benchmark against industry averages. Vertical analysis highlights the relative importance of each item, helping analysts spot unusual or concerning proportion. Ratio analysis uses key financial ratios to evaluate a company's performance. Common ratios include liquidity ratios, profitability ratios, and solvency ratios. Liquidity ratios, like the current ratio, measure a company's ability to meet short-term obligations. Profitability ratios, such as return on equity, assess how efficiently a company generates profit. Solvency ratios, like the debt-to-equity ratio, evaluate long-term financial stability. These ratios provide quick insights into financial strengths and weaknesses. Liquidity ratios are crucial for assessing a company's ability to cover its short-term liabilities. The current ratio, calculated as current assets divided by current liabilities, indicates whether a company has enough resources to pay its debts. The quick ratio, which excludes inventory from assets, offers a more stringent test. High liquidity ratios suggest financial flexibility, while low ratios may signal potential cash flow problem. Profitability ratios measure how effectively a company generates profit from its resources. Key ratios include gross profit margin, operating margin, and net profit margin. Return on assets (ROA) and return on equity (ROE) are also widely used. These ratios help stakeholders evaluate management's ability to generate returns and control costs. High profitability ratios typically indicate strong performance and competitive advantage. Solvency ratios assess a company's ability to meet its long-term obligations. The debt-to-equity ratio compares total liabilities to shareholders' equity, indicating how much of the company is financed by debt. The interest coverage ratio measures how easily a company can pay interest on outstanding debt. Strong solvency ratios suggest a lower risk of default and greater financial stability. Efficiency ratios evaluate how well a company uses its assets and manages its operations. Examples include inventory turnover, asset turnover, and receivables turnover. These ratios reveal how quickly inventory is sold, how efficiently assets generate revenue, and how promptly customers pay their bills. High efficiency ratios often reflect effective management and streamlined operations. Market value ratios provide insights into how the market values a company's shares. Common ratios include the price to earnings, PE ratio, price to book, PB ratio, and dividend yield. These ratios help investors assess whether a stock is undervalued or overvalued compared to peers. Market value ratios are essential for making informed investment decisions and understanding market sentiment. DuPont analysis is a powerful tool for breaking down return on equity (ROE) into its component parts: profit margin, asset turnover, and financial leverage. By analyzing these elements, you can pinpoint the drivers behind a company's ROE and identify areas for improvement. This method provides a deeper understanding of financial performance and helps guide strategic decisions. Common-size financial statements present all items as a percentage of a base figure, such as total assets or total sales. This approach makes it easier to compare companies of different sizes and analyze trends over time. Common-size statements are particularly useful for benchmarking and identifying structural changes in a company's finances. Trend analysis involves examining financial data over several periods to identify patterns and predict future performance. By tracking key metrics like revenue, expenses, and profit margins, analysts can forecast growth and anticipate challenges. Trend analysis is a valuable tool for strategic planning and long-term decision-making. Variance analysis compares actual financial results to budgeted or expected figures. By identifying the reasons for variances, organizations can take corrective actions and improve future performance. This process is essential for effective budgeting, cost control, and performance evaluation. Break-even analysis determines the point at which total revenues equal total costs, resulting in neither profit nor loss. This calculation helps businesses understand the minimum sales needed to cover expenses. Break-even analysis is vital for pricing strategies, cost management, and evaluating the viability of new projects. Leverage refers to the use of borrowed funds to increase potential returns. Financial leverage can amplify both gains and losses, making it a double-edged sword. By analyzing leverage ratios such as the debt-to-equity ratio, analysts can assess the risks and rewards associated with a company's capital structure. Risk analysis evaluates the uncertainties and potential losses in financial decisions. By identifying and quantifying risks, organizations can develop strategies to mitigate them. Common tools include sensitivity analysis, scenario analysis, and value risk calculations. Effective risk analysis is crucial for sound investment and business planning. Sensitivity analysis examines how changes in key assumptions impact financial outcomes. By adjusting variables like sales volume, costs, or interest rates, analysts can see how sensitive results are to different scenarios. This approach helps in understanding potential risks and making more robust decisions. Scenario analysis explores the impact of different future events on financial performance. By modeling best case, worst case, and most likely scenarios, organizations can prepare for a range of outcomes. This method is especially useful in uncertain environments and for strategic planning. Value at risk, or VaR, is a statistical technique used to measure the potential loss in value of an asset or portfolio over a defined period for a given confidence interval. VaR is widely used in risk management to quantify and control exposure to market risks. Understanding VaR helps organizations set risk limits and make informed investment decisions. Cost volume profit (CVP) analysis examines how changes in costs and volume affect a company's operating profit. By analyzing the relationships between fixed costs, variable costs, sales price, and output, businesses can make better pricing and production decisions. CVP analysis is a key tool for budgeting and forecasting. Budgeting and forecasting are essential components of financial planning. Budgets set financial targets and allocate resources, while forecasts predict future performance based on current trends and assumptions. Together, these tools help organizations plan for growth, manage resources, and measure progress toward goals. Financial modeling involves building mathematical representations of a company's financial performance. Models are used for valuation, scenario analysis, and decision-making. They typically include assumptions about revenues, costs, investments, and financing. Mastering financial modeling is crucial for analysts, investors, and business leaders. Discounted cash flow (DCF) analysis is a valuation method that estimates the present value of future cash flows. By discounting expected cash flows at an appropriate rate, analysts can determine the intrinsic value of a business or investment. DCF is widely used in investment analysis and corporate finance. Net present value (NPV) is a key metric in investment decision-making. It represents the difference between the present value of cash inflows and outflows over a project's life. A positive NPV indicates that an investment is expected to generate value, while a negative NPV suggests it may not be worthwhile. The internal rate of return (IRR) is the discount rate that makes the NPV of an investment zero. IRR is used to evaluate the profitability of potential investments. Projects with an IRR higher than the required rate of return are generally considered attractive. IRR is a standard tool in capital budgeting. The payback period measures how long it takes for an investment to recover its initial cost from cash inflows. While simple to calculate, it does not account for the time value of money or cash flows beyond the payback period. Still, it's a useful tool for quick assessments and comparing projects. Return on investment (ROI) is a widely used metric to evaluate the efficiency of an investment. It is calculated by dividing net profit by the initial investment cost. A higher ROI indicates better performance. ROI is useful for comparing the profitability of different investments or projects. Earnings per share (EPS) is a key indicator of a company's profitability on a per-share basis. It is calculated by dividing net income by the number of outstanding shares. EPS is closely watched by investors and analysts as it influences stock prices and investment decisions. Dividends are payments made to shareholders from a company's profits. The payout ratio measures the proportion of earnings distributed as dividends. A high payout ratio may indicate a mature company, while a low ratio suggests reinvestment for growth. Understanding dividends and payout ratios is important for income-focused investors. Applying financial ratios in real-world scenarios helps analysts and managers make better decisions. By comparing ratios across companies or industries, you can identify leaders and laggards. Regular ratio analysis supports ongoing performance monitoring and strategic adjustments. While financial analysis is a powerful tool, it has limitations. It relies on historical data which may not predict future performance. Accounting policies and estimates can vary between companies, affecting comparability. External factors such as economic conditions can also impact results. Being aware of these limitations ensures more balanced and realistic conclusions. In addition to quantitative data, qualitative factors play a significant role in financial analysis. These include management quality, industry trends, competitive landscape, and regulatory environment. Considering both quantitative and qualitative aspects leads to a more comprehensive evaluation of a company's prospects. Financial analysis supports a wide range of business decisions, from investment selection to resource allocation and risk management. By providing objective, data-driven insights, it helps leaders make informed choices that align with organizational goals. Integrating financial analysis into decision-making processes enhances strategic planning and operational effectiveness. Advancements in technology have transformed financial analysis. Tools like spreadsheets, financial modeling software, and data analytics platforms enable faster, more accurate analysis. Automation and artificial intelligence are increasingly used to process large datasets and uncover insights. Staying current with technology enhances your analytical capabilities. Ethical considerations are vital in financial analysis. Analysts must ensure accuracy, objectivity, and transparency in their work. Misrepresentation or manipulation of data can lead to poor decisions and damage trust. Upholding ethical standards protects both organizations and stakeholders, fostering a culture of integrity. The field of financial analysis is constantly evolving. New regulations, technologies, and market conditions require ongoing learning and adaptation. Staying updated with industry trends, best practices, and emerging tools ensures you remain effective and competitive as a financial analyst. Let's apply what we've learned with a practical case study. Imagine analyzing a company's financial statements to assess its profitability, liquidity, and solvency. By calculating key ratios and comparing them to industry benchmarks, you can draw meaningful conclusions about the company's strengths and weaknesses. This hands-on approach reinforces the concepts discussed throughout the video. Visual tools like charts and graphs make financial data easier to understand and communicate. By presenting trends, comparisons, and key metrics visually, analysts can convey complex information more effectively. Good visualization supports better decision-making and stakeholder engagement. In summary, financial analysis is a vital skill for understanding and improving financial performance. We've covered key concepts, methods, and tools, from financial statements to advanced analysis techniques. By applying these principles, you can make more informed decisions and contribute to organizational success. Continue exploring, practicing, and refining your skills to stay ahead in the world of finance.